Hello, everyone. I'm Ernie Humphrey, the CEO of Treasury Webinars. I'd like to welcome everyone to our webinar today, APAR and Treasury, creating harmony to control your cash conversion cycle. Before we dive in on the exciting housekeeping items, I'm going to welcome my favorite webinar co-speaker, John Paquette. He's the VP of Solutions in the U.S. for TIS. John, why don't you jump in and just give us a little bit about your background and what you do at TIS for us?
Yeah, sure. Thanks, Ernie. I'm John Paquette, VP Solutions, like Ernie mentioned. So I oversee our Solutions Architects team and our customer onboarding team. So I've been with TIS since 2019, and really prior to that, all my experience was on the practitioner side. So I spent about 15 years working with Treasury organizations directly in various Treasury roles. So always happy to kind of talk about these topics like the one we have today. And Ernie, thanks for having me on.
All right, John, always a pleasure. I do want to make sure that I thank my thought leadership partner today. TIS had a very long relationship with them, and they certainly get my commitment to thought leadership. Also excited that they share my commitment not only to the folks that use the product, the companies, but also they have a commitment to impacting the professional success of all the folks that use their products, and that really is starting to go much more across the office of the CFO. I also want to mention they have great thought leadership content on their website, and they also do their great events as well. I always like to listen to my partner John on TIS Coffee Talk, so please be looking for those as well. Now for the exciting housekeeping items, stay in your seats, everyone. If you're interested in a certificate of attendance for today's webinar, you'll have to answer all the polling questions and remain on for the duration of the webinar. If you'd like a copy of the presentation, please send an email to Ernie@treasurywebinars.com. Again, any questions about certificate of attendance, or if you're interested in a copy of today's presentation, Ernie@treasurywebinars.com. We have a very, very short survey at the end of the webinar today. We appreciate everyone's consideration in taking that survey because we always strive to offer you more value. There's more and more webinars out there, and we know we have to keep on getting better like everyone else. So we have that continuous improvement initiative. So what we're going to do today, John and I are going to have as dynamic as possible, actually, a conversation. So I'm going to be bringing John into the conversation, and then later on, John's going to drive us through some slides as well. If you have any questions, we can take those in the questions area of the GoToWebinar control panel. We'll do our best to get to those, time permitting. If not, we'll follow up with you directly afterwards. So first, to kind of set the stage, we're going to talk about the cash conversion cycle, near and dear to my heart. Any of you that follow me know that I am on my pulpit all the time talking about how to own the cash conversion cycle, and to me, I think we should focus more on that on Treasury. To me, that means taking more control, right, of how and when we pay folks on the AP side and how and when we get paid on the AR side. And I think in Treasury, we've traditionally focused on what happened, and it's very important, bank reporting, communications, all that good stuff, but we really need to focus on why it's happening. So we need to understand the why, not only so we can optimize those movements, but also to get predictability into those movements as well. And part of that, understanding the why, means collaborating with our colleagues in AP and AR. We'll get into all these topics. There are still silos that exist even within Treasury. There are silos within AP, silos in AR. So we'll talk about how to facilitate that collaboration. And so as we go through the process, we're going to go through some survey results that I have. I do a lot of surveys now. And so we're going to give you the lay of the land. So maybe you're not in AP or AR. So we're going to share with you the lay of the land to help you understand the challenges that those areas are facing, and maybe some of the technology that they're leveraging you might not be aware of. And then that's going to help you have impactful conversations and be able to collaborate with them. We'll also, of course, include some Treasury results, the surveys I partnered on with TIS. We're going to talk about the whys of cash movements, and then, of course, we are going to have some key takeaways as well, and, of course, polling questions along the way. A lot of that sometimes is to benchmark how the audience compares to the research that we've done. I also want to mention, if you want copies of any of the research that I covered today, please send me an email to Ernie@treasurywebinars.com. Happy to share those with you. So Some of this stuff may be review for some of you, but I want to make sure that it gets covered. And so a lot of times there's a lot of different definitions for things. So I want to put a box around what we're talking about today. So when we want to look at the cash conversion cycle, right? I talk about control and dynamics, and so I really like the graphic on the left here. I try to do my own graphics, but I was pretty poor. And so really what this really does, it really gets into obviously related to cash conversion cycle, right? So it gives us a stage working capital. Let's look at this in terms of a manufacturing, production, storage, right? Then we have, boom, we have accounts payable. We need to make our product. We need to pay our vendors, right? And then we want to get our sales going on, AR side, AR collections, right? And then we start the process. So we're investing in working capital, and then we're harvesting that. So to put a box around, to me, this is what Treasury is all about. This to me is financial transformation. This is what financial transformation should be. Control how and when you pay, control how and when you get paid, which mean, and part of that means optimizing the amounts and timings of cash inflows and outflows, right? If you're not involved in Treasury and you're talking to people outside Treasury, they don't understand how complicated it seems. Like, wow, that's really easy. But as many of you know, this can get extremely complicated. So just real quick, when we talk about DSO, that's day sales outstanding, right? We're not going to do any formulas or anything. And DPO is days payable outstanding. So for your preview after the webinar, just to kind of level set on there as well. I really like this diagram from my friends at TIS. This is probably one of the best that I've seen. It really gets into the whole dynamics across the cash conversion cycle, and so you see, right, the enablers. And so, look, we're enablers, AP, AR, accounting. So we need to have harmony, right, across all those folks, right? Outbound payments, inbound cash, and then we go on the other side here, right? On the production process, flow of cash, flow of goods. And so I always talk about collaboration today. What's also important is that we optimize our relationships as we collaborate with AP, with our suppliers, right? And with our clients. We don't want to make our customers upset. And then here is an extremely important piece here, right? On both sides, right? The bank information and connectivity and communications there. John, is there anything you want to add on this slide? I mean, I really like this, and I just wanted to get, if you had any color or things that you like or things you want to point out as we dive in here.
Yeah, I think what this slide's really trying to call attention to is that all these activities that you see under that enablers sort of heading there, right, are all connected. Historically, I think a lot of these departments have just focused on their own operations, like take Treasury, for instance. Treasury needs to interact with the bank to make payments, to pull down reports, to do cash positioning and things like that, right? But really, all these activities are somewhat interrelated, and both in the sense of data flows. Treasury is a facilitator for these other departments. If you think about AP needs to leverage Treasury connectivity to the banks to send out payment files, right? Batch payment AP files. That's straight through processing. That's been best practice for 10 plus years now. Likewise, accounting is connected to Treasury and some of their systems from the standpoint of bringing in bank reporting, flowing through Treasury communication channels with their banking partners to facilitate automated reconciliation. And then even from a data sharing standpoint, Treasury needs information from AP, AR for forecasting purposes, right? And Treasury is also kind of uniquely placed in that they see everything when it turns into cash, so they have a lot of good insights that they can then share back with these departments based on the reporting that they're generating today. So I think that's really what we're trying to draw our attention to here today. Understand how everything is sort of connected and how Treasury can kind of be, sort of a facilitator of communication between these departments.
Right. Thank you so much. Yeah, to me, you did it perfectly. It's like what we're trying to communicate here is, there can be many cogs in the wheel here, right? So any points of friction, process and friction, asymmetries of information, all of these things can impact, right? Can throw these things off. Predictability, efficiency, right? Damage supplier relationships, damage customer relationships. So as we set the stage, right, I want to talk about a real high level, right, the art of collaboration. So before we do that, I'm going to go ahead and launch our first polling question here. Okay, I got my polling questions in some interesting order here. So, okay, let's go ahead and let's do the AP one first. Let's do a different polling question. All right, just want to ask you, how do accounts payable and treasury collaborate together, right? Do you agree, neither agree or disagree, I'm not going to tell your boss, if you say you neither agree or disagree. So even when I go to AP conferences, I have people come up to me afterwards and ask me, how do I collaborate with Treasury? And I have Treasury folks come up to me and ask me how to collaborate with AP. So we're going to definitely get into that discussion. Part of it is really taking an interest, right, in what the other person is doing, knowing their language, knowing their challenges, just being able to, have that face-to-face conversation and make a connection on a personal and professional level in order to facilitate that collaboration. So I'm going to go ahead and leave the polling question up for another few seconds. Then we're going to go ahead and take a quick peek at that, and then we're going to get back into how to facilitate collaboration across the office of the CFO, no matter what department you're in. So I'm going to go ahead. We're almost got 80%. Come on, everyone, just click the button. But I like to get as many answers as possible. So I appreciate you taking a minute. Just click the button. Thank you. I'm going to go ahead and close the polling question. I'm going to go ahead and share that. So keep this in mind as we go through survey results later on. I'm glad to see that 75% of you agree. We still have 25% that really don't feel that you can agree. So I think just have the mindset. Even if you agree, think about how can I do a better job? What does that mean to you? What is the level? Kind of questions I ask folks. Let's say you're in Treasury. Do you collaborate with AP on the types of payments that are being made, right? We don't like to write checks. Sometimes we have to. Credit card, ACH, right? Credit cards, research, ghost cards, virtual cards, right? And things like that. And then think about, do you do that? But do you also collaborate on the timing of payments, right? When I was in Treasury, we did check runs two times or once a week, I think, and was that best? I don't know. We really didn't look at that, right? So what is the timing of the payments? You thinking about it? Are we taking discounts, right? Are we facilitating discounts? So just things to keep in mind as you think about how you can collaborate from Treasury and AP to Treasury, right? On that side of it, think about it. Are we giving them the best forecast that we can, right? Are we asking them, right, to give us direction, right? Maybe how to communicate what payment types are best, right? How can we work together? So let's go ahead and get back to the content. So interesting. So let's get back to, kind of just getting that mindset. And so for me, but let's just say for me on Treasury, so I'm having a few people that are saying audio time. So if you are having audio issues, I strongly encourage you to dial in using your phone. So usually it's a connection on your side. So if you are dialed in and then you lose your audio, I would be really surprised. So please go ahead and do that for me. Apologize for jumping in there, but I want to make sure everyone is hearing the audio. All right, so at work, so your professional brand, whether you're in APA, Treasury, whatever, finance, you have a professional brand at work. And the better your professional brand at work is, the more open people are to collaborate with you, and people are going to organically want to collaborate with you. So here's my advice. Know what you know, right? I know Treasury, I know these things. Appreciate what you don't know, right? Maybe I've never been in the weeds of AP and AR, I need to learn. You should invest in knowing your colleagues, right? I should invest in knowing my AP and AR folks. People are all human beings, right? They all like to have interaction, right? Let people get to know you. That might be a little hard. For some of us, not me, are a little introverted, so you have to let people get to know you. Don't walk around with your head down, right? Try and have your head up. Try and be positive. Try and leave the home at the home and let people know that you're willing to let them get to know you, but you have to be authentic. You can't go around and start telling jokes if you're an introvert. So not everyone's outgoing like me. I get that. And then you need to be able to communicate what you know, right, to folks, like know what you know, and be able to communicate what you need to know, right? Communicate that. I'd like to know more, and then actively collaborate there. So those are things that are important there at work. John, does anything stick out to you like this has worked for me, this is what I think people could do better, if you had to pick like one of these things to help people be more open at work and get collaboration going?
Yeah, I'd say maybe invest in knowing your colleagues, just because in the work from home era, there's probably fewer opportunities to actually do this. It becomes a lot harder. Back in the office days, you had all the time in the world to pop into somebody's office or swing by and introduce yourself. But now people are not in the office maybe 1-2 days a week, or maybe not at all. Or also a lot of the times, you might be in Treasury, but the individuals you're most interested in getting to know are located in a completely different office. So a lot of this stuff has to be done virtually for the most part, but definitely take advantage of those opportunities and maybe even try to create them to be able to get to know your better by, look for face-to-face type situations.
Yeah, that's a great point, because I think I know a lot of people who are managers, right, they had to come up with inventive ways to engage like your Treasury team. Well, how about, we do similar things and engage our colleagues like AP and AR. So maybe we have a lunch meeting, a conversation, we send everyone a gift card for lunch, right? And we facilitate those opportunities to just talk or share, or you can even, do games or whatever people were doing. But those techniques that you used during COVID to engage your team, you might have to go up the ladder a little bit. Maybe as the CFO, we want to make sure, that we have our folks communicating and giving each other the opportunity to build those relationships. So thank you, John. Great point. These are kind of the same. I think a few things here that are different from the last slide. Understand the value of your relationship to your colleagues. So you need to, if you can, to develop that, right? So Treasury, right? If you do your job better, I do my job better, right? So I'm a Treasury person. I understand payments. I can help you. I have knowledge. We think we have maybe a different mindset, right? And you need to be able to communicate that. And then sometimes I would say I'd go over, talk to people and folks, say, hey, I was just on this webinar about AP automation. What are we doing here, right? What are some of the things that are most aggravating to you guys at work, and start that conversation. And then when you're in these relationships, let people know what to expect from you, right? Communicate your expectations. So, hey, I'd like to work with you. Or maybe you're like, hey, the CFO told me to work with you guys. Hey, I'd love to work with you guys and understand more. If we could work together, I'd like to get more information from you. I'd like to meet and go over the variances, right, between what we're supposed to go out the door for AP, what your forecast was, and what actually happened. Be great if we could meet. It'd be great if we could do this, and communicate your expectations from them. And so you actually have that alignment there. And then a few more things. John kind of touched on these, and this is what I need to work on every day. I don't do it enough. Listen, right? Be present, be on the meetings you should be on, even if they're virtual, right? Listen to folks, ask questions, right? Inspire people to open up. I'm doing pauses on purpose. Pauses are a great way to let people fill conversation. Learn the professional languages of your colleagues. And so, right, even us in Treasury, unless you've invested in it, we really don't know all the AP lingo, the AR lingo, so make that investment. I talked about this. Ask them their biggest challenges. Help them solve their challenges, right? Usually that's mutually beneficial. Be authentic in your communications, right? Be who you are. I think this is important. A lot of times you're working on a project together and you want to communicate bad news practically. So maybe in Treasury we did something, it's going to impact AP, or maybe AP did something wrong. It seldom happens, of course, but maybe they messed something up and the bank file got messed up, and the money, we're going to see something different than we thought we were going to see in terms of what was going out the door. We didn't take this discount. It might cause a supplier issue, right? So let's build those relationships so they feel comfortable with that, right? You have trust in someone, right? If they have no fear in communicating bad news to you, and you have to, you have to make sure you have that same, same level, right? You are willing to do that as well. So I think, that's important as well. John, you share with us maybe one thing, because you're a longtime Treasury person, one thing that you did or got better at doing that helped you collaborate more effectively beyond Treasury?
Yeah, I think so. I think one thing that we did well was we got everybody involved in sort of the short-term cash management, the short-term
Okay.
cash. That'd be the AR, the AP departments as well.
Mhm.
Just at least like once a week to sort of validate what we had on there on the cash projection, have them bring an input. Hey, you guys are missing this. This slipped into AP late, or it's considerable in size, whatever it might be. But I think it helped a lot with people sort of getting tied into how their business activities impact others, and in particular cash. Everybody understands cash,
Right.
right? So,
Yeah.
so I
Yeah.
always thought it was nice to be able to kind of bring everybody together in that sort of shared context and understand how all their business
Right.
activities come together.
No, I think that's amazing advice. And I always have to bring up what I did way back in the day is, and this is an exercise, and I'm not trying to say it should come from Treasury, but this is a kind of a Treasury focused webinar. Is I had to understand and map out every person or system that impacted cash movements, right? How does cash move across the country and come in, and why? And then I had to present that to everyone in the whole finance, AP, AR, controller. And so having that ability, and what happened after that was over, all the AP people and AR, they're like, I didn't understand you guys were doing that. So they understand, like John mentioned, all the dynamics and the impacts, right, that they're having. So being able to possibly just have that meeting of the minds, right? In addition to that weekly, just kind of have that out there. Once people understand the challenges and all the other stuff that other people are doing, it makes collaboration. I think it makes collaboration easier. You kind of feel like you might not be in the same department, but I think it helps people on the same team. So as we look to collaborate with AP, we're going to go ahead and take a little look at the lay of the land of AP. So let's go ahead and I'm going to share with you some survey results. So we'll go through AP, AR, and Treasury. One of the things we'll talk about is the responsibilities and expectations, right? And what that looks like, and then what are the resources that people have available, and then how we can collaborate. So again, if you'd like the survey results, let me know. Just released the survey like a week ago or so. So responsibilities of the AP team, we asked people, right, beginning, what does that look like in 2023? They're going to increase, right? So 63% increase significantly. And more importantly, right, you're going to have more time to spend on strategic activities. So that's pretty cool if you're able to do both, right? You don't want more responsibilities that make sure that you're doing more manual tasks, right? So you'd like to see more time spent on strategic activities as well. So just like us Treasury folks, what's going on is there's more responsibilities of the AP team, and the good news is a lot of companies are letting their time. They have more time to spend on strategic activities. So your AP colleagues may be more receptive to you coming over, and they may come over to you. So let's be proactive, right, in doing that, but let's also be receptive in that. So I think that's pretty exciting, for my AP folks on here, right? So, and also understanding the mindset. So another question that we asked was, are you going to spend more time collaborating with Treasury? So I was pretty happy to see that 42% said they expected to spend more time, so that's good. So it's cool to see the survey results line up, right? But we'd like to see more responsibilities, but we have more time to do strategic activities. In that strategic activities, we'd like to be involved in Treasury. Another good thing that we wanted to see was, what about the time spent on supplier relationships? That increase was almost 50% as well. So in my mind, both of these things would facilitate more control of how and when we make payments. So also, we're going to collaborate with Treasury, make strategic decisions on what and how we pay, and we're going to have better relationships with suppliers, so they're going to be receptive to any changes that we might want to make, and anything that we can do on our side to help AR more efficient on their side. So John, anything jump out to you on the last couple slides as we look at the AP landscape?
Yeah, I thought it was interesting to see that, the increase in time spent on strategic activities for AP, because you don't traditionally think of AP as like sort of a strategic center. They're high volume processing, sort of keeping the business running by paying the bills. But when I saw this, time spent collaborating with Treasury, I think it made a little bit more sense, because, Treasury and AP can collaborate together in a very basic sense in terms of how payments are being made, making them electronically, making them through low cost instruments, making them through things like virtual cards or, instruments that kind of extend payment terms. And even, other products come to the market like supply chain financing, dynamic discounting products where
Yeah.
Treasury might actually be trying to use payables as sort of a yield optimization instrument, as an alternative with your idle cash to investing in short-term cash instruments. You could go ahead and pay your bills early and get a return on that. And if you're doing those sorts of things, you're probably collaborating strategically with AP quite a bit, right? So I think the market is kind of moving in this direction a little bit. And I think these results make a lot of sense from that standpoint.
Yeah, absolutely. Yeah, a couple of things you mentioned. Yeah, especially, on the supply chain side, we're seeing just continued, unforeseen dynamics on that side. So that's more important than ever. And then, as you mentioned, as we get visibility into discounts and opportunities, right? I think that helps that as well. And one of the things that I didn't show here, John, which we do on my survey with you guys, is we ask people to define what is the role of AP at your organization. And just like in Treasury, we are seeing a lower than expected percentage, I think in the 20 percentile, 20 to 25% of is AP viewed as purely a transactional, right, department with no purview to strategic matters, and that number is pretty low. And then these results kind of confirm that, but also, as you're saying, the dynamics of the challenges that companies face, but also visibility into opportunities that they have by giving AP more time, but also understanding the value that you can realize from AP done right, is pretty exciting. Again, what you just mentioned, John, right? All those things, right, that you mentioned, right? It makes Treasury look good as well, right? And it impacts the bottom line. So it's definitely a win-win. So just kind of understanding the payables a little bit. So I'm trying to give folks a resource. If you want to understand, you want to dig into the process and understand the language, right? So you might not understand all the things, right, that are going on in AP, the challenges that they have, right? Real quick, you capture code and send the invoices, send to you guys approvals, right? What does that look like? We want to be able to see what's going on. What are the bottlenecks? But also there may be opportunities to make your life easier as an approver, right? Authorized for payment, right? So we're all familiar with that. That process is often inefficient, right? And then we have the approval history and the audit. So very, very basic here, but just think about the challenges they have, but also think about how important visibility is in Treasury, but that goes kind of across the enterprise. And so kind of understanding what challenges they have. And then when you're all working together to think about what does our tech stack need to look like to the CFO, then we need to look at, an AP automation solution, but maybe we can get all that we want, right, from that in a suite approach as well. So you need to kind of look at that. So just real quick, visibility, right, into people. What does that mean? All the people involved, so you might not know that. So we look about collaboration in AP done right besides Treasury, right? We have procurement. These are the things that they do. Identify and vet vendors, negotiate contracts. Very important for us to have visibility into payment terms, right? Because we may not have as much control as we would like because it's in our payment terms. AP, supplier relationship management, and then we have all of our approvers. You can have PO approvers across enterprise, supplier approvers, payment approvers. We can have all these folks, director, procurement, AP, controller, treasury, CFO. So there's a lot of people involved. And we also want to understand, we talked about the why of payment. So I'm always curious about why you're making a payment. So you ask folks, right? I would expect to see processing costs, right? But to me, I see what people say and then the reality of what we see in the market, and it makes sense, right? Preference of our customers, that's interesting, 26%. So here's the part where this might be why the AP automation market is still hot. 23%, it's the way they've done it. 16% convenience, 4% no reason at all, right? So to me, as a treasury person, I need to make sure in my organization that we have a reason. You can't assume that AP is strategically, right, choosing those payment types. And there's a lot of different processing cost differences and also risk exposures based on your payments type. Was this surprising to you at all, John, or with what you see, it's not as surprising as I might think?
Yeah, maybe a little bit. I mean, seeing 30% in processing costs, that makes me think, those individuals are probably collaborating with Treasury to understand the low cost processing methods,
Right.
probably ACH and the sort of low value, non-urgent type payment
Yeah.
types. But there's a lot more that can be done here. I mean, even introducing something like a virtual card payment, for example, a virtual card program, you can be turning your payables into like a revenue opportunity, right? So there's definitely a high percentage that aren't sort of thinking strategically from that standpoint. It seems like from these survey results, and maybe an opportunity to do so even more.
Yeah. All right. Thank you. So here's another thing that I always get on my soapbox about. We ask them if they collaborate with suppliers to how they pay them, and then only 30% said they let your suppliers choose. And I'm not suggesting that that's always a good thing to do, but it can be detrimental if you force someone to do it. I mean, I'm not trying to pick on AP solution providers, but some of them force people to use virtual cards and accept those, and that can be very dangerous in the sense of supplier relationships, and especially nowadays with the supply chain issues that we have. So my suggestion is some level of collaboration, and sometimes, on paper you might think, hey, I want to make everyone do a virtual card so I can get a rebate. Well, some people, they might have to step. Getting them off of checks is a big deal if you can do that to an electronic payments, and then you can optimize that. But you want to be making strategic decisions. This is a data-driven decision, right? I'm collaborating with the supplier. Sometimes you have to educate them. You have to be honest with them, right? What's the costs and benefits to them, on that side of it. And so there's obviously a lot of opportunity. So that's our AP dive. We're going to go ahead and switch to AR. So we're going to ask you a question around that, and asking you to share your thoughts. Do AR and Treasury collaborate relative to how and when you get paid? So agree, disagree, neither agree or disagree. So again, if you're interested in receiving certificate of intents for today's webinar, you'll have to answer all the polling questions that we ask, and appreciate everyone's consideration in answering all of our polling questions today. We're going to go ahead and leave this up for maybe another 10 or 15 seconds. I got to make sure I leave John some opportunity to cover some of his really compelling content here as I go to my happy place now. It seems as AP and AR Treasury, and really trying to optimize AP and AR. So I want to give John this opportunity to share how technology is letting us put all these things together, and how Treasury is the place to drive that. All right, let's go ahead. Oh, thank you. Better response. Let's go ahead, close and share. Interesting. We have a lower percentage that agree to that. So we've seen there's opportunity in AP. There may be even more opportunity in AR, and that's interesting. Even because from my experience, it was a little more common for AR to report up through Treasury through maybe the treasurer than it would be from AP from my experience and survey results. So thank you for answering the polling question. So we're going to go ahead and dive into the similar results, right? We're going to cruise through these a little more quickly, make sure John has time to share his great insights. So we looked at the responsibilities, right? It's also increasing, right? Again, 59%, right? And then we look as a strategic role of AR, gone up or down. It's gone up, right? Again, these big numbers. And so we see there's more expectations of AR as well. And of course that makes sense, right? When you see all the dynamics going on that, about the economy, the inflationary environment, geopolitical environment, depending on where you stand, where you sit, but still, it's still out there. There's a lot of dynamics, and there's a lot of headwinds out there that a lot of companies are facing. So hopefully we'd expect to see that. And then we actually ask a little bit of a different question, getting at collaboration. So what we found was AR teams, they actually work inside of us. So if you're in AR, right, or in Treasury, you got to get your house in order. You need to make sure you're not only collaborating internally with your team, right, colleagues in your Treasury, but that's we got to get your house in order, and then in order to collaborate outside, because it should be easier for you to break down those silos within your own department, and that will give you some ammunition to break down those in AR. So we asked some related questions here to look at cash projection accuracy. That's a top priority. That's awesome. You know, it's over 3/4 of the company. And then we also see that there's going to be increased time collaborating with Treasury. So you Treasury folks are going to be popular, right? We saw well over 50% AP and AR. So we really hope that we're going to see that. So that's incredibly encouraging there. So they should be open to that collaboration. So we're glad to see that. Then we also asked them if AR works with Treasury to improve collections forecasting accuracy, and we got a pretty big percentage there, 56%. Happy, I'd like that to be a lot higher. So it's good to see that they're going to work to that. So I'm hoping that those numbers will go up. So maybe they align, right? They're not there yet, but given that they said they're going to spend more time, and this is an area that we can really engage our AR colleagues there. So let me go ahead and let's turn the channel to Treasury, and let's go ahead, and John, I'll let you go ahead and run the show for us for a while.
All right, thanks, Ernie. Yeah, similar results to what we saw before for AP and AR, but just focusing more on Treasury from this slide standpoint here. You know, how do we see Treasury responsibilities evolving year over year, 2022 to 2023? And they're increasing. You know, Treasury has more on their plate than ever, it seems like, and that's certainly what we're hearing, you know, with conversations with treasurers as well. But I think the positive there is that the time spent on strategic activities is increasing as well. You have, you know, nearly 80% of organizations, you know, feeling that they're going to spend more time on strategic activities. So you're doing more, but you're also kind of doing more strategically within the business, which I think is really nice. And I think this is kind of driven from two different standpoints. Maybe the payoff in investments that Treasury's made in technologies to automate certain processes, right, that allow them to focus more on strategic activities. I think there's been a lot of investment in Treasury over the years. And I think also just sort of the recognition of Treasury's, you know, unique place within the organization, that they're sort of sitting in the spot where everything turns into cash, right? And sort of the way that they can kind of facilitate a lot of insights and sort of good data sharing amongst the business. If you kind of look at the next slide here in terms of, you know, Treasury's control and influence beyond just Treasury, it's growing. You know, there's a lot of categories here, just about everything where Treasury has at least direct control or indirect control. But definitely the two biggest spikes that you're seeing here within the AP department, right? Second from the left here, where, you know, 45% have direct control and another 24% have indirect control. And then also the AR department, right, where you have 40% with direct control, 27% with indirect control. So those are big numbers, and it shows that Treasury is playing a big role, either directly or collaboratively with those two departments. And you know, there's certainly a lot of good reasons for that we've sort of touched on already, and we'll touch on a bit more in the slides moving forward here. So if we look at this in the context of, you know, framing up these relationships in the context of a true Treasury sort of activity, cash forecasting, I think, is an ideal one to see why these relationships are so important. So, you know, on this side, we have the typical forecasting categories that most Treasury organizations are using. And you can already see AP, AR, right? Those are number one, number two, right? And you know, those are probably your most volatile projection categories, in the sense that it's really hard to predict those accurately without really good information, really good sort of coordination with those departments. So you definitely need those relationships. CapEx as well, right? In that sense, you're probably working pretty closely with, you know, whoever's responsible for the capital budgeting, maybe FP&A, maybe also the individuals responsible for managing the capital projects or the capital equipment purchases, right? And then probably also AP to understand what might be in there for spend that's already been invoiced related to some of your capital expenditures. You have your non-operating cash flows. Here we're probably talking more, you know, the big ones, at least Treasury items, your loan related activity, your loan pay downs, your interest payments, your fees, even deal items like FX settlements and things like that, right? Bringing those into the forecast. And then other, you know, probably what jumps to my mind the most is, you know, when you look to extend your forecast beyond just the sort of short to medium term, you're probably incorporating in true financial projections. And then from that sense, you're working pretty closely with FP&A on what the budgeted financial statements look like. So, you know, point being here, to put together a really good forecast requires a lot of, you know, collaboration amongst a lot of different departments within the organization. So, and then, we talked about AR, like I mentioned before, AP and AR are probably the two toughest to predict. A lot of the items here listed on the slide, supply chain disruptions, and definitely the geopolitical dynamics, the kind of the events of the last 2 to 3 years have drove a lot of unpredictability into AR. I know when the pandemic hit, a lot of Treasury departments that's when they kind of started having those direct conversations with AR, because suddenly, DSO was at an average of 30 days. It spiked up to 40, 45 days as the incoming payments just, really slowed down quite a bit. So that caused unpredictability. But in general, there's unpredictability in the forecast, I think, based on the quality of data that you have, obviously the granularity of that data that you can get into your forecast. Are you projecting off high-level AR balances, or are you projecting off individual invoice level ARs? Are you applying broad assumptions or very, very specific assumptions as you drive cash there? Are your billings up to date? Does your AR include your unbilled revenue? And then you probably have considerations too in terms of, how far out can you accurately rely on this data? So your AR information, invoice level, or even with an assumption put across it, probably only accurately predicts, AR related cash inflows for a 6 to 8 week period. And then you're looking at sources beyond that too. And then probably the other thing to call attention to is that there are businesses out there that don't have AR. The one that probably stands out the most is, retail, or anybody that has sort of a store model, where individuals are actually going in there. And then from that perspective, you're probably forecasting this based on sales projections and maybe, patterns of when individuals are visiting your store, more revenue, more receipts coming in on a Saturday than a Tuesday, for example, right? So there's definitely a lot of factors that make this really complicated for organizations to project accurately. Then looking at the other end of the equation, AP, a lot of the same sort of, criteria that are making this a tough one for companies to predict as well. So, everything listed here on this slide, definitely misalignment on payment terms. If you're thinking you have an average DPO of 60 days and it's actually 45, obviously that's going to have a really meaningful impact on cash. Also, AP, you're looking at, what's been invoiced, right? So you're sort of making an assumption that you can project cash based on the invoices they have in the system. A lot of companies we talk to like to combine that with PO data to see what's coming up, right, for expenditures that maybe haven't been invoiced quite yet. But then sort of looking at those two criteria and making sure you're not duplicating certain cash outflows, right? So marrying up a lot of different sources that kind of come into play as you're projecting out your AP disbursements and making sure that those maintain sort of the right balance and don't duplicate, some of the expenditures that you're forecasting there. And then you have the same sort of considerations around how far out can you rely on this data. For most companies, maybe they have, 6 to 8 to 10 weeks of good AP data that they can forecast disbursements out accurately. And after that, you're looking more at your expense data and trying to apply some, DPO assumptions to determine when those expenses will turn into cash. At that point in time, obviously, it makes sense to have a really good handle on, where your organization is running from a DPO standpoint. What are the different considerations and things to kind of fine tune that forecast and make things more accurate, right? So, and then as we look at, kind of the combination here, variance analysis for most companies, this kind of means, two different things. I think, for companies looking at forecast versus actuals, which is a weekly activity, seeing how you performed in comparison to your forecast, and then looking at different forecast periods. How's the forecast evolved since we created at the beginning of the year versus, the end of Q1. If we even look at the ending Q2 cash balances, that changed significantly in our forecast, the way that we've analyzed things. So. And, when I think about variance analysis, I kind of, think of two different things that you're trying to determine here. One is, I think, true forecasting error. Are your variances caused because something in your forecasting methodology is off, or one of your forecast inputs is the wrong source, or, something like that? Or is your forecast off due to business performance? Did the business underperform from a revenue standpoint? Or are days sales outstanding much higher than you were using in the projection, right? And this is where I think it really makes sense to work between these departments, AP and AR, and also try to get as granular as inputs as you possibly can into your forecast, because it's just going to drive much better variance analysis. You're going to understand why the forecast is off, even pinpoint it to certain business activities. And when you get to that state, that's when Treasury can really be a strategic partner to the business. You can actually go out to the business and say the AR department and say, hey, our cash receipts over the last 2 weeks, they've been off by 10 million. We've tied it back to a creep up in our DSO, and it seems to be attributed to these 6 key payers. You're taking what's sort of a just reporting function in terms of variance analysis or cash forecasting and turning it into an insight that you can then share amongst the business and actually make things better. So I think that's key too for relationships as you sort of think about your cash forecasting. And then forecasting in terms of how you leverage technology to kind of make this better. Obviously, technology helps quite a bit in sense of combining and synthesizing data. Spending more time on analyzing outputs rather than creating reports, right? That's probably the key thing. But this slide kind of calls attention to the steps that you have to undertake here. Very, very briefly, I'll go through this. This is obviously a lot of detailed sort of inputs that go into this, but understanding your unique drivers of cash flow is critical, right? Really being able to marry up a cash flow to a source in that sense. We talked about AR and AP data being used to forecast, obviously, a high percentage of your AR cash receipts and AP cash disbursements. But depending on your business, that might be unique. I brought the retail example in there where you might be using more sales data and other metrics to be able to understand what your cash flow is going to look like. Understand your working capital drivers, because that's going to be a key input as you get into your methodologies, where it's the business running from a day's sales outstanding, a day's payables outstanding standpoint. Define your preferred cash forecasting horizon. Are you trying to put together a short-term 8-week forecast, 12-week forecast, or are you trying to go out all the way to 52 weeks? Because that's really going to play a big role in terms of number 4 here, and identifying the cash forecasting source per time horizon. So like I mentioned before, if you're just putting together a short-term cash forecast and looking to be accurate within a couple weeks time frame, a lot of your data is going to come from the ERP system in terms of your AP and AR information, and other sources that maybe you're in better control of, like your Treasury cash flows and things like that, your CapEx cash flows. If you're looking to really extend that out past 26 weeks and you're talking about getting into your financial projections, your budgets and things like that too, and really understanding the metrics that you need to use to sort of translate expenses and revenue into cash flow, and making sure that you're really, really sort of secure in terms of what that methodology looks like, right? So, and then integrate and consolidate global data within some sort of technology platform here. So, I mean, that's what I sort of brought up in terms of if you're bringing everything into an automated source for forecast aggregation, you have more time to analyze that forecast and pick out those business insights. Also, if you're consolidating forecast inputs from multiple different business lines, like a lot of companies we work with are, having a way to do that automated instead of spending 2 to 3 days combining all that information into a forecast just makes such a difference in what you can do in terms of actual cash management with that data. Define your cash forecast logic and core assumptions. That's kind of fine tuning that methodology that you put into your forecast. And then sort of 7 is sort of a long-term objective, but applying some level of machine learning and AI algorithms over your forecast. If you've gotten everything else squared away and you're looking to really get deeper insights into your forecast and are available at the surface level, AI and machine learning can do a lot for that, right? It can just pick out a lot of trends and things like that that wouldn't be apparent to the human eye, both for business partnership, being able to draw insights into the business, and for refining your forecast methodology as well. So, and then hopefully you achieve number 8 here, a fully optimized short and long-term cash forecast. But there's it's not as if you have to jump to that sort of end state, that number 8 there. There's sort of the way we think about it, steps along the way. And really in the one that we have on the screen here, which is what we consider to be sort of a walk approach, you're talking about manual data uploads. So maybe extracts from your ERP system for your AR and AP balances, bringing in bank data, bringing in some of your treasury related entries, your CapEx data manually. And even though you're not automating the process of creating the forecast, you're automating the process of consolidating that data and letting the machine create the forecast. And once again, you're getting to that state of being able to analyze the forecast much, much quicker. That's the biggest pitfall we see in cash forecasting with most businesses, is that they spend just way too much time in the forecast creation. And the forecasting process becomes just, the action of creating a report and publishing that report within the business, right? And that's sort of the objective. Where really what it should be is that you create the report and then you use that report to manage cash within the business. And so that's kind of what we're talking about with Walk, is just getting to that, right away. even if it's not super sophisticated, if you get this data into some sort of an automated model and you can analyze it, you're going to learn so much about the business, about how cash moves in and out. And it's going to help so much with further refining that as you progress through more advanced steps of your forecasting here. It's also probably going to spark a lot of conversations with external departments as you look to fine tune that data, AP, AR, FP&A, whatever it might be, right? So, and then if you look at the sort of the next approach, the so-called, what we call the fly approach to cash forecasting here on the next slide. This is much more about, or the run approach here on the next slide, sorry. This is much more about, being able to, I think we need to trigger one more visual to pop on the screen here. Yeah, here we go. Getting more granular about the data. So in this case, you're looking at bringing in more data into the system that's at a very, sort of more specific level, primarily AR and AP invoice level data. And the difference there is you're not projecting based on a broad DSO, DPO assumption. You're projecting cash flow based on the individual invoices, the individual customers and suppliers, and the terms that you have with them to be able to identify when the cash flows related to those items are going to occur. And that does a lot in terms of making your forecast more accurate, but it also lets you achieve some of the things I was talking about in terms of the variance analysis. You're really understanding that at such a more detailed level. The specific reasons for why your forecast's off, particularly if it's a business reason. Was our DSO up, was our DPO down, whatever it might be, right? That's sort of making cash disappear or making you do better than the forecast, and then positions you really well to sort of be a strategic business partner within other departments, pointing out sort of how these activities are impacting cash flow or areas the business might want to focus on. And then as you go to fly, you're talking about incorporating AI machine learning into some of this near-term stuff. It's very situational how you might want to apply those technologies, but sort of one broad example there is that if you're driving your forecast based on invoice level AR and AP data that's based on payment terms, your believed payment terms with those customers and those suppliers, but the reality is that certain customers always pay 5 days past term or 8 days past term, and you want the technology to pick out those trends for you and sort of incorporate it into a different version of the forecast, call it a more conservative version of the forecast. Those are the types of things that technology can do for you that would just take humans hours and hours and hours to sort out, right? And then you have a more accurate forecast, and more importantly, you understand what the risks are in the forecast. Before the variance analysis where you might be off, and having insights earlier is obviously way better. And then, the other component of that is obviously the longer range forecast when you're incorporating in your FP&A, your budgeted financial forecast, which is, sort of the best source to have there to project out longer range cash flows, but also same thing. If you're doing that forecast over, that period over period forecast comparison, say, our June 30th forecast, what do we think it was as of, the beginning of the year versus, say the end of Q1, how has that differed? Why is that different now? And is it tied to, actual forecast logic issues, or is it tied to business performance, right? And understanding that sort of differentiation is really important. And then this last slide here, it just calls attention to, where you kind of end up in this process. Depends on where you start, obviously, where you are now. But if you're on a very basic Excel-based forecasting process where you're just projecting out based on, say, like historical averages for cash inflows and cash outflows, you don't need to jump all the way to this AI-based forecast with this, 52-week period incorporating in P&L data. You can progress along the way. And that's actually a better approach because you learn about the business, you learn about the right inputs to incorporate into your forecast. You build those relationships internally with AP, AR, and the different areas that are providing the forecast inputs, and you progress to a better place in a way that is more specific to your business. And with a forecast, you're going to understand much better in the end. So, and Ernie, with that, I think I'll turn back to you here for some takeaways.
All right, John. Thank you so much for your amazing insights. Just to kind of, before going to the key takeaways, I think it was readily apparent as we look at, controlling cash, but also delivering predictability, right? The importance of that collaboration, right, across AP, AR, and Treasury, and John even, of course, we'll touch on in a second, FP&A as well. And so we've seen the importance of that, and all these different areas can cause inherent friction, but they can also, there's a lot of value to be delivered as we collaborate across the enterprise, and as we start to understand right? How we can help AR be more efficient and AR be more efficient, right? We're lowering costs, we're removing productivity barriers, we're allowing more time for strategic activities. We're also giving ourselves a lot of business agility. So I think that all fits together extremely nicely. So I'm going to go ahead and launch the final polling question here as I go through our closing key takeaways for you, which are extremely important. You need to invest in relationships across the office of the CFO, no matter where you're at, AP, AR, and Treasury. We've given you some tactical advice for how to do that. Be authentic, I say, be yourself. Let people get to know you. Invest in getting to know people, including getting to know the languages of your colleagues as well. It'd be great to take a deep and honest dive into your entire AP, AR, and Treasury process. So that includes, right, you're probably going to collaborate. Let your AP person do that. Let your AR leader do that. And then and then Treasury, and then let's all sit down and really look, what does cash management done right really look like, and where are we at? Where can we get to, and how are we going to get there? I strongly suggest investing in technology. Visibility is key. Can't manage what you can't see. Again, we talked about P2P, OTC, your customer or supplier relationships, your collaboration. We want everyone to have access to functionality that empowers data-driven decision-making, which requires collaboration. We want to invest in technology. Again, we want to eliminate asymmetries of information. And then the alignment of AP, AR, and Treasury, what that does is that really empowers control and predictability of cash, which offers tremendous value in any company. So I'm going to go ahead to let you know, close the last polling question. Those of you interested in receiving the certificate of attendance, I'm giving you one last chance to go ahead and get that polling question if you want that certificate of attendance. Everyone, if you could please take a moment and click that as a courtesy to myself and also my webinar partner, thought leadership partner. They make these webinars possible. So if you can click the button, I'd appreciate it. So as we wrap things up, I do want to let people know, we talked about collaboration. Treasury Webinars is actually partnering with the FP&A guy to do a FP&A demo day. So if you're interested in that, there'll be the opportunity to let me know that on the survey. Want to once again thank our thought leadership partner, TIS. Love their commitment to thought leadership and our partnership. Want to thank my co-speaker, John. John, thank you so much. Always a pleasure. Always enjoy your insights in our conversation. John, thank you so much.
All right. Thank you as well, Ernie.
And with that, I wish everyone, I hope you have a fantastic day. Make the rest of your day great. Until next time, everyone.